Hi, everyone. Welcome to the Personal Finance webinar, part 2 of our 5-part series. We're really delighted to have you all here today. Last week, we had the Personal Finance webinar on credit, so if you missed it, you can catch the recording on our website or on our YouTube channel. We'll also have 3 more after today, every Tuesday for the next 3 weeks, on insurance, taxes, and then finally investments. But today, we're going to talk about budgeting. Before we dive in, I'll give you a little bit of background on Dowling and Yahnke. We're an independent wealth management firm. We manage over $4 billion in assets for about 1,200 clients who comprise individuals, families, and nonprofit organizations. In addition to investment management, we also provide a comprehensive suite of financial planning services. My name is Hope Carlson, and I'm one of the lead advisors here at Dowling and Yahnke. Joining me today is Eric Nelson. We'll both introduce ourselves as well before we get started. As a lead advisor, I serve as the primary point of contact for my clients with the firm, but we have a very collaborative, comprehensive team approach in how we work with people as well. My background is that I have a smattering of different pathways. I worked as a strategy consultant for about 4 years at the Boston Consulting Group, sandwiched around my MBA from Harvard. I also pursued a Master of Music and Vocal Performance and Literature from the Eastman School of Music, so I'm a trained opera singer. And right before Dowling and Yahnke, I spent about 6 years as the Chief Development Officer overseeing fundraising and marketing for the San Diego Museum of Man. So I have a passion for philanthropy and really enjoy talking with my clients about that as well. Eric, I'll turn it over to you to introduce yourself.
Thank you, Hope. Hello, everyone. I'm Eric Nelson. I am one of the financial planners here at Dowling and Yahnke. My role within the firm is to assist clients with our financial planning needs, particularly planning for, into, and throughout retirement. I'm a local San Diego native, working in the industry throughout San Diego over the last half-decade. I have my certified financial planner designation, as well as my master's in financial and tax planning. I will be running things on the back end of today's webinar, so for those of you joining us live, you will see a question and answer box on the bottom part of your screen. If you have any questions that do come up throughout today's presentation, we encourage you to submit those questions using the question and answer box. We will receive those on our back end anonymously, and we'll seek to address those throughout today's presentation. We've also set aside a few moments and a couple minutes at the end of today's presentation to go over a question and answer session and answer any questions that we do not address throughout the presentation as well. We will also be recording today's webinar, so if you are joining us via the recording, we also encourage you to reach out to myself or Hope via email with any of those questions. And again, we'll loop back around and answer any of those questions that do come up. We look forward to having us today, and Hope I'll throw it back to you.
Thanks, Eric. As Eric mentioned, our email addresses are below our pictures here, so do feel free to reach out to us directly if you happen to be viewing the recording. In addition, if you would like to be sure that we're able to connect with you regarding your question today, feel free to include your name and contact information in the chat box when you send us those questions in the live presentation today so that we can reach out to you directly. Now we'll dive into budgeting. One of the things that I think is helpful is just to have a little bit of time and space to think about what is a budget. How many of you create your own budget? Do you track how you're doing versus your budget, and how often do you do so? Do you know what you spend each month versus what you make, which is really the definition of a budget, and what's left over for savings? Why is it even important in the first place? We see budgeting as the secret to taking control of your lifestyle, and we'll talk about 2 main scenarios today. In the first, maybe you're on a fixed budget. Maybe you're receiving a monthly stipend. Perhaps you're a high school student with an allowance, or maybe you're in college and you get a certain amount of living expenses every semester. That means that you really are not thinking about retirement plans and contributing to those. You're not necessarily planning for fluctuations in income, but you're looking instead at how best to allocate the income you have to an array of expenses. Another scenario, perhaps you're eating lots of donuts, drinking lots of coffee, and working, and you're thinking about both the income and the expense side of the equation. Income minus expenses gives us this net income figure, and we'll talk a little bit more about what it means to budget in that scenario as well. Budgeting basics. No matter which type of income scenario you're in, thinking about your budget comes with 3 categories: savings, needs, also known as fixed expenses or non-discretionary expenses, and wants, discretionary expenses. In the savings bucket, we have things like your emergency fund, which we'll touch on a little later, and your retirement plans, your 401k, Roth IRA, and so forth. For needs, these are all the things that would be very hard to cut back on. They're things like utilities, your electricity and your water, your housing, the tuition and student loan payments you have, your phone, your food, your healthcare. You can make changes in these categories and pick less expensive options, but overall, you still need to eat, you still need a place to live, you still need to pay for that electric bill every month. So these are the needs. And then wants, that concert you might want to attend, perhaps virtually now, given the current circumstances, gifts you might want to spend, travel, a trip you might want to take eventually, cable TV. These are some things that fall in the wants bucket. As you think about your budget in each of these categories, you can make an itemized list, a cash flow statement, cash coming in versus cash going out. Here we have an example for someone who is working with the income at the top and the monthly wages and 401k plan contribution they might be making. That gives them about $3,600 net that they can spend on all these different expenses. At the top, you can see that we have the needs categories. These are the pieces that we fill first. And picking a line item method like this to be able to categorize everything can help you really get a sense of all the different places your money's going. Wants on the bottom here are usually what we think about with what's left over. But this person is also fortunate to have a little bit of a surplus down at the bottom here, this $250 left over that can be used for savings or other necessary expenses. You want to cover your needs before you want your wants. So you can take that line item chart and turn it into a pie chart. And if you're on a fixed budget, that monthly allowance or stipend, this is one way to think about how you're spending that money too. As you create this pie chart with all the different categories, what we see is that you can divide it up and figure out how much is going into needs versus wants versus savings. It's really important not to forget about that 10% that is being allocated to savings in this particular example. So you want to make sure that you're setting funds aside for savings for yourself as you plan for your future. How do you get started? Well, there's an array of tools out there that you can use. Some of them are online, like Mint or EveryDollar. They have apps, they're automated, some connect with other accounts you may have to help you with tracking. Others are a more manual process. You can take 3 months or more of your bank or credit card statements. And we recommend that you do at least 3 months because there are sometimes expenses that come up as one-time expenses. Your expenses can vary from month to month. So you want to make sure you're getting a good sense of the averages and the trends that you have. You can put everything into Excel. This is one of the budgeting templates that you see on the right side of the page here. And then that will help you figure out the projected cost versus what you're actually spending and how things are differing month to month. Tracking is really the name of the game. So you want to consider and plan for the upcoming expenses that you may have and the non-recurring expenses. These are the ones that can be easy to forget. That one-time car maintenance payment that's coming up, or maybe you have a new phone you're going to buy, or travel you're going to be doing, or maybe there's an insurance payment that you only pay once a year. Be sure to take a holistic look at your year so you can keep track of those and won't be surprised.
Hey,
oh yes.
First question coming in. Question asks, when you're getting started with putting together your budget, how often should you kind of look at or revisit putting together that budget or adjusting it?
That's a great question, and it really depends on how things are going for your personal circumstances. So if your life is very fluid, maybe you're a gig worker in the gig economy, you're driving for Uber or Lyft, or you're a freelance DJ or something, then your income is going to be going up and down and fluctuating a bit. So you may want to be revisiting that a little more frequently. On the other hand, if you have a pretty consistent set of income and a consistent set of expenses month after month after month, you're looking at your credit card bill and you're seeing that things are pretty stable, you could go a few months before you revisit it. But generally speaking, we recommend taking a close look more frequently when you're starting to budget to make sure that you're capturing everything. And then as time goes by, maybe it will be on a quarterly or semi-annually basis. That's a good question. Thanks for asking. You also want to be sure that you're paying yourself first. So we think of this in 3 steps. First, you want to pay off your credit card debt. This is debt that is typically very, very expensive. If you're carrying a balance on your credit card, that could be 14%, 18%, 20% annual interest that you're being charged. So if you had a $1,000 balance outstanding and a 20% interest rate every year, that's $200 a year on top, more because of compounding. So pay yourself first, pay that off. That's like a guaranteed rate of return at whatever the interest rate is on that credit card, and that's pretty good. Next, be sure you fund your emergency fund. This is something that we will talk a little bit more about in a few slides. And then finally, fill up your retirement bucket. This is saving for your future, so make sure that you are planning ahead. Even a little bit that you set aside now can go a long way to helping you down the line. Emergency fund. What is this emergency fund? Well, as you can see from the very sad car on the right side of your page here with the license plate that says broken, this is not a happy vehicle. And maybe some of you have had a car who has limped along like this and struggled, and you have those surprises where all of a sudden you've got another several hundred, several $1,000s maybe going out in a surprise way that you were not anticipating. Emergency funds are there to cover that kind of surprise. They're also there to help you if you lose your job. And if you don't have income for a little while, how will you cover your needs, the ongoing rent, utilities, food expenses that you have? You need something set aside for that. So this is the buffer if you lose your source of income. This is also helping you in case you have those unforeseen expenses, whether it's the car or whether something breaks in your apartment. This is what you use instead of racking up a bunch of credit card debt. How much should you have? Generally, we say 3 to 6 months of expenses, which is why it's very helpful to have a budget so you know what 3 to 6 months of expenses looks like for you. And if you don't have 3 to 6 months set aside in cash in your bank account, which is where we typically advise keeping your emergency fund monies, start with something lower, a target like 2 weeks worth or $1,000, and gradually save up over time. How much do you really need between that 3 to 6 month balance? Well, you need a little bit less if you have other sources of funds that you can tap. If you own your home and you can take out a home equity line of credit, that can be one source of emergency monies apart from your bank account. If you have friends or family who could cash flow you for a little bit, who could help you with some of the funds that you need, then maybe you're a little bit on the lower side of that spectrum, as long as you're pretty sure that they can help you out. If your partner has a stable job where it's very unlikely that they're going to lose their job, then you might need a little less. On the other hand, maybe you have kids, your expenses are variable and they really need to be fed. They can't just live on ramen. Your work might be variable. You might be part of that gig economy, as we were talking about earlier. So then that tips you more towards the 6 month side or even longer. Retirement bucket. This is one of the places that we get a lot of questions. So there are a lot of different options for retirement. How do you know where to save first? Well, number one, we say meet your match. If you're working for someone who has a 401k plan and offers a matching amount up to a certain level that you contribute, do that first. That's basically like free money, and you want to make sure you get that. 2, fund your Roth IRA if you're eligible to do so. And a Roth IRA is an individual retirement account. This is something that if you have earned income from salary, wages, etc., that you can set aside, then you want to put it into a Roth IRA if you're able. There are income limits on this, but if you are above the income thresholds, you can also talk with an advisor about how to do something called a backdoor Roth contribution. What we love about Roth IRAs is that they are after-tax money going in, but then they grow tax-free and you can take the funds out tax-free in retirement. So especially if you have a long time before you retire, this is a wonderful way to save. As one of my colleagues says, it's like paying tax on the seed instead of the crop. Third, you want to top off your 401k if you have funds left. So this year, the limits for a 401k contribution for individuals are $19,500 plus an extra $6,500 if you're 50 or older. And the limit for a Roth IRA is $6,000 for 2020, or an extra $1,000 if you're 50 or older. So if you have that much that you can set aside, great, do it. And then finally, if you're looking beyond that, fund your brokerage account. So this is a taxable account in which you buy stocks and bonds, and you can invest in a well-diversified portfolio. In a few weeks, we'll have our investment webinar. Please tune in for that, and you'll be given some more guidance on how to think about investments that may be in that brokerage account or otherwise.
Hey, Hope, we have another question going back to the emergency fund. And the question is related to what exactly does it mean 3 to 6 months of expenses? I think when you're saving your emergency fund, should that be 3 to 6 months of your total expenses, just your needs and your wants? Kind of how should we be thinking about, what encapsulates that 3 to 6 months?
Sorry, my mute seems to be delayed. Yes, that's a very good question. So 3 to 6 months is, we think about it typically as needs for sure, things that you cannot change easily. And then whether or not you include your wants is up to you. We typically think that what you need, if you're in that kind of a situation where you have a job loss or really need to be thinking about covering your expenses out of your bank account instead of your income, that you may not be doing concerts and gifting at quite the same level that you were before. So often we think about it in terms of the needs bucket, but certainly if you want to include wants and not, it's helpful to have a bigger buffer sometimes, and certainly for your own peace of mind, that's something to consider as well. Okay. Thanks for the question. Our next page here, as the slides decide to move. There we go. So how do you actually set aside funds for your emergency fund or for your retirement? What if you feel like you're just completely stretched in terms of using every dollar of your income for your expenses? How do you find the savings in your budget? Here are a few ideas. Maybe you're getting Starbucks every day. Could you make coffee at home? Some folks might save up to $125 a month or more, depending on how venti that venti latte is. Maybe you're cutting the TV cord. Maybe you're reducing not only cable, or you're cutting back on streaming services. Maybe you have Netflix and Hulu and Disney Plus, and you're only going to have one of them. Maybe you can eat out a little bit less. If you're doing a lot of takeout right now, think about what you could cut back by going to the grocery store instead. And what if you kept your iPhone for that extra year rather than jumping on the latest model? This all adds up. We talk about this as the latte factor. It's about more than just lattes. So if we look at an average cup of gourmet coffee, as of April last year, MarketWatch said this was about $4.24 on average. If you're getting that every day of the week, that's $29.68 a week. 52 weeks a year, that's starting to look a little pricier at $1,543 a year. And if we put it into the market, and let's say hypothetically it grew at 6% for 30 years, knowing that nothing grows consistently year over year at 6%, it'll fluctuate, but let's say for this example it does, you would save $129,815. That coffee can really add up. This is because of compound interest. You earn interest on the interest on the interest. As time goes, you get exponential growth. Your returns build on themselves. This is why time is a key factor in saving. If you start saving early and you are consistent, or you save often with just that little bit, that $4.24 a day, It really adds up. It also puts you in the driver's seat, so you can take charge of where every dollar goes by being aware and thoughtful about how you're spending your money. That means that the key takeaway, habit. Small changes can make a really big impact. So what are the changes to the daily habits that you can make? Don't grocery shop hungry. I don't know about you, but every time I go to the store, if I haven't eaten yet, I find that I've filled my cart with all kinds of things, most of which are not very good for me because I'm just craving everything I see. And that can be expensive. Pack your lunch instead of eating out. Make coffee at home. Follow up on those student discounts. And there are money saving apps. Gas Buddy, Snip Snap, Retail Me Not, Ibotta. And take a look at the utility company peak hours. So SDG&E, our local utility company, publishes information about this. So you could run the dishwasher or the washing machine or the dryer in times that are off times, off peak, and save yourself some on your electric bill. Student loans. Another common question that we get is around how to think about student loans. Get to know them first and foremost. Are they federal? Are they private? If they're federal, are they direct subsidized, unsubsidized, plus loans? What about the grace period? Do you know how long that is for you? And be sure that you pay on time. Prioritize the payments. This is part of paying yourself first. Automatic payments are a great way to do this because it just comes right out of your bank account. Make sure you have enough in your bank account, but that's a helpful way to be sure that you're not missing payments. And don't increase the payment period. There are ways that you can change how you pay for your student loans and that can add time on, but that just means that you're going to pay more in interest charges, which can add up quickly. So if you can, pay them off within the standard 10-year period and pay off the highest interest rates first. If you can make additional payments, look for the loans that are the most expensive first. Take a look at your prepayment options too. If you're running into difficulty, take a look at deferment, which can pause payments temporarily. Interest still accrues on the unsubsidized and plus loans for that, but it can still be worth it sometimes. And loan consolidation, which can potentially get you a lower interest rate. You can consolidate the federal loans with each other, but you can't consolidate private loans with federal loans, and you can only do it once. So take a look. Now is a good interest rate environment. It might be worth exploring if you have some student loans out there. Finally, tax deductions. This is a way that you can deduct up to $2,500 on the interest you pay on your student loans each year if you are within the income thresholds to do so. One additional note, this year is unique. There is legislation called the CARES Act that passed because of the COVID-19 situation, and it automatically stopped federal student loan payments from March 13th through September 30th. Interest on many of these loans is 0% during that time. So take a look at your options there as well. If you can continue to make payments, you might want to consider doing so because that also can reduce your loan burden overall, but it provides some relief if you're encountering some financial hardship during the current time. Finally, you want to crunch the numbers for those major decisions. Whether you're thinking about buying a car or leasing a car, whether you're thinking about buying a home or renting a home, run the numbers, run the analysis. It'll be different for every person in terms of what the right decision is, and it'll be different depending on what's going on in the current market environment. We often get questions about leasing or not leasing a car, so here are a few last-minute tips and tricks to think about for that. Things to consider if you're leasing. This is when you're basically, it's almost like renting the car. It seems like a lower cash flow. You'll see all the car dealerships having ads about lease it for only X amount a month, but you don't own anything. So while it seems less expensive at the outset, you don't actually get to walk away with it. And there are mileage limits. If you exceed those, or if you get outside the wear and tear constraints, you can incur some hefty fines. Plus, you always want to look at the interest rates. Buying, on the other hand, you do get to own the car. You might need a down payment, so you might have to have some funds set aside, saved up. But you can also modify and customize it to your liking. And again, look at the interest rates. So leasing, when should you lease? If you want a new car every 3 years, that might be a better option for you. And if you think you can stay within the mileage limits and wear and tear constraints. On the other hand, if you want to drive the car long term, you can afford the monthly payments, buying is a pretty good option. What may be the best option is to buy a certified pre-owned or used car, though, because depreciation, meaning the drop in value from when you buy the car to when you're driving it now, it can be a lot. So the moment you drive it off the lot, it starts to drop in value. And one rule of thumb is that about 15 to 20% of the value of your car is lost every single year. So if you're looking at a car that's certified pre-owned or used that has some low mileage and is a relatively recent car, that might be the best deal you can get. Great. I think we'll turn it over to Eric for some more questions.
Yeah, thank you, Hope. Question we have here that came in is, if it's ever too early to start a budget, I think it maybe relates to your point on if you're kind of in that fixed income stage before you're working, if it's really too early to kind of start putting together your budget at that point.
That's a great question. And I think I would answer it by saying your budget doesn't have to be complicated. So I don't think it's ever too early. I think, let's say you're listening to us right now and maybe you have a 4-year-old child who is starting to think about what does it mean when we go to the grocery store and we pull out money to pay for something. You can start talking about budgeting then. You can even help a 4-year-old or a 5-year-old start budgeting by, well, if I give you $5, what are you going to do with it? Would you like this or that? There are ways that you can make budgeting very simple for yourself. You can also make it very complicated. I think it's a wonderful frame of mind to start to think about and practice early on, because as your financial life gets more complex, having the basic skills under your belt and having it be a little more second nature will help you as you're starting to make more intense financial decisions as well. Good question.
Yeah, thank you. But another question we have here is how to think about additional payments on various debts. So things like student loans or credit cards. If they have already made their minimum payment, essentially, how should they think about prioritizing within their budget, either putting that excess money towards things like retirement savings or possibly paying those sorts of debts down further?
That's also a great question. So there are a couple different ways to think about this, and it does depend on your unique situation. So please feel free to follow up with us afterwards as well, and we're happy to talk you through the specifics for you. But in general, there are a couple vantage points. One is, what are the interest rates on the debt that you have? And if you are looking at the debt that you have as, maybe it's a 7% interest rate, that is a pretty high interest rate. Anything above that, if you think that your portfolio would earn less than what you're going to pay on the debt, then it makes sense to pay down the debt. On the other hand, there are some tax considerations and there are some limits to what you can set aside for retirement. So that's something we would factor in as well for you. Certainly the opportunity to contribute to a Roth IRA or your 401k provides you with tax advantages in terms of the savings that you're able to do there. So it's very unique to your situation as well.
Great, and I think our last question that we have came in here, just wanted a little bit clarification on kind of a typical budget, which I think maybe you had laid out in the needs wants savings breakdown. And maybe kind of applicable again to the person, but maybe just reviewing again what kind of that typical budget would look like, of how to segregate and categorize each of those different expenses.
Sure, absolutely. And I think what might be helpful is if I go back to that slide here. Let me see if I can pull it back up for you. As I'm flowing through the slides, I'll tell you a little bit more about how to think about it. I think you can probably guess some of the obvious categories as you're starting to think through what you need to spend every month. And that tends to occur to people first as, well, I need to eat, I need a place to live, but it's really within that how you group things. So here we go. The housing expenses are a whole collection of things. Maybe you're in a condo and you have an HOA, etc. So, group them that way. It's always a little bit easier to list out in greater detail everything you're spending, and then add a category for that, especially if you're working in Excel, that you can roll it up into, just to be sure you're not forgetting anything. So my advice would be to start with a very detailed list, just track every dollar and put it together, or use one of the automated tools which will help you categorize things in a way that will make sense to you as well. And then, use these as your basic categories that you can roll it up into. Some of the ways that people go back and forth in a budget, it's an iterative process. So you'll be thinking about what you're currently spending or what you have spent in the past, but then you'll also be thinking about how much you would like to allow for spending. Maybe you've been doing a lot on the entertainment front and you want to cut back. And so you're going to give yourself a budget of $200 a month, $100 a month, whatever that looks like. And you're going to try to track your expenses to stay within that as a ceiling for you. On the other hand, you're in a lease potentially, and that goes for a while, so you know that your monthly expenses on that front are going to be that set amount. It's a very fluid process that you want to keep updating over time.
Great, thank you. That was the last question that we did have come in at this point.
Great. Well, thank you all so much for your time today. It has been really a pleasure to talk with you. I'm glad that we were able to spend some time together, and please do feel free to reach out to Eric or to me if you have additional questions. We're happy to help.